what you guys have seen in the market right now. What's your take on the recent? I mean, the emerging companies in the market.
Can you say that again? I actually didn't hear it. And
So
Matter, you can take the lead with you.
I said the emerging cap rate in the market. I'm looking at a deal with assumable debt, right? Which is but the cash flow is already close to market. I mean, the rent is already close to market, so there's little room to increase the rental. But the interest rate on the assumable debt is about 1.7. So there's a huge trade-off between getting the interest rate within the market about 6 to 7% right now, and taking on a deal with no room to increase the cash flow in terms of the rental. The current rent rate is it's at the market level already. So you see the dilemma there. So you're barely covering your cost, barely covering the debt service. So there's no enough cash flow. Does that make sense?
I catch your drift. So
Because the debt service is 1.5 right now. Ordinarily, for a debt that has just 1.67, I would expect to have a debt service ratio of about 2 or 2.5. Does that make sense?
yeah.
Considering what the market is right now.
And when you say the market, are you being hyper local,
Then
or are you talking
no,
Canada
the,
wide?
the interest the interest rate is about 6 to 7% in the market. But there's a deal that I can take on the debt. They have about 2.7 million in debt at 1.7% interest rate.
Mm.
The challenge is that it's not cash flowing well. Because if it's cash flowing well, the debt service coverage ratio should be 2 plus, not 1.5.
Mm.
And that is
Does
with
that
the
make
lower,
sense?
and that is
Yeah,
with the
because
lower interest rate.
yeah, that's what I'm saying. Because of the lower interest rate, it should be higher than that. It should be higher than, even though the time is 5 years and the amortization is 30 years. It should be higher than 1.5. So what I'm looking at is there's not enough cash flow on the deal because the room to increase the rental is not really there because the rental is currently at the market level. So what I'm thinking, so you'll be on that before I tell you what I'm thinking.
Amanda, what do you think? I have a few questions, but I'll let you take the lead.
Yeah, I mean, so like that is definitely a concern with such a low interest rate, and is still not the ratio doesn't really look good, and if you have to refinance the project, like refinance the debt, then like you're most likely gonna get a higher interest rate, and at the same time there is no scope for
Increase the rent.
no scope for increasing rent either, so increasing revenue. So
Mhm.
yeah, I mean, from what I can understand from just the brief introduction, I would say there's definitely something wrong, but maybe with such a low interest rate, and you're saying the mark. I'm sorry, where is the location? Like, where is this property?
Edmonton.
Edmonton. Okay. So even if you consider that, maybe there might be some things that you can look at, from an operating expenses perspective, that's taking up a share of that cash flow that we should be getting on an EBITDA level. Maybe they have some extra expenses that you can cut down. So I would say, if you are really interested in this deal, and overall, in the current situation, I would say it doesn't look like a good one, but I would suggest look into the operating expenses, like what are the expenses? Maybe there are some expenses that you can cut down and increase the cash flow. Because what many people do is like they have like higher expenses than what is needed to run the the building. So that's all I can think of. Like, I mean, yeah. What do you think, Natu?
I mean, that's really what you said covers a lot of things I didn't think about. I'm just wondering what the the occupancy rate is, and then it's like how much can you burn the occupancy? Like how much can you do on the occupancy rates? That's all I was thinking.
It's a 3 units, so you say I have about occupancy of 94%. So that's just about 3%. 3 units vacant.
It's hard. Yeah, I think it's hard.
It is hard.
Yeah, because if you were, that's the only thing I was thinking about. But I'll just look for another, unless it's hard to find others.
Yeah, because I was looking at that, but I wanted somebody else's opinion because I know it doesn't make sense at that low interest rate, and the only debt coverage is just 1.5. I would expect the debt coverage ratio of about up to even 3x because it's quite low, and I'm talking about 75% LTV.
Yeah.
So it's not as if it's 90 or 95%.
Correct.
Yeah, and those are my thoughts. But I guess one question is just so then the commercial lender the term was for how long again?
Yeah, I still have 3 years to go. The term ends 2025 June, so approximately 3 years.
Yeah, well, and God knows what will happen in the world by 2025 at this rate. But
Yeah. Go on.
Yeah, so I don't really like even though I'm skeptical on the economy for the next year or so, like I don't expect the interest rate to stay that high for a long period of time. Like they would have to go down like in maybe like if not in next year then maybe a year after that. So like interest rate will go down for sure, like after a certain point. You never know when. But at the same time, like I would actually Adi, you have been involved in this real estate for quite a while, so you have a really good idea of the the operating expenses of any of a similar kind of a project. So
about
maybe
45%.
Sorry.
The market is usually about 45% to 50%. So
So
to be on the safe side, you usually do 50%.
Yes. So maybe for this company, they have like certain expenses that are not the standard ones, and that you might be able to cut off. Because like if you're saying the real estate is almost fully occupied with current market rates, and it is in in an Edmonton kind of area where the demand is kind of high. So I don't really understand like why are this so low. Like the only thing I can think is like definitely they have some certain operating expenses that shouldn't be there, and maybe you can look into that, and if you can cut down those expenses, this might turn out to be a good deal.
Okay. So what I've done is to actually just model it for just 3 years instead of 5 years. So to exit when the loan ends. Well, yeah, more or less when the time of the loan to exit that period. So the issue of having to take on a new debt and new leverage at higher interest rates is not factored into this. Does that make sense?
Yeah, no, definitely. Like, so that's why, like, so first step, like, if I'm analyzing this business, right, like, the first thing I would do is, like, look at the current numbers, and if there are, like, any room for improvement in that. And after that, like, if there is a room for improvement and it does improve, then factor in the higher interest rate and the new mortgage refinance, like, when you do that. So I think, like, that the first step would be to just analyze the current financials the company has.
Yeah. Now the current financials, it has been more or less normalized. Okay, this is the market, so it's been normalized. So that's the issue. So
Oh,
I just, yeah, it's been normalized. Okay, this is standard according to CME state, this. The things that you have no control over is utility. Okay, you have control over utility, you can reduce that. What you don't have control over is the tax. You don't have control over the insurance. And you have no, you still have a bit of control, but yeah, generally you don't have control over it. Because some of those things can challenge it. Then the property management fee, you have no control over that because that's what you sign up with, right? You sign up for 3% or 4%, and that's what they charge based on whatever revenue you generate or rental revenue that they generate on a month by month basis.
oh.
Okay, I just wanted to have your thoughts on that. I think primarily that's what I just, and I don't want to bore everybody with this. That's why I
Just,
feel like to grab it.
uh, just one follow-up question, Adi. So
Yeah.
the current owners, like the price that you're getting, so are you getting like so what price are you considering? Like, so are you just like buying it at the same price the other person bought it, like maybe a year ago, 2 year ago, or something like that?
It's some of this. This is an old building, so most of it has been well renovated on the outside. But yeah, I think on this they're looking for 111,000 per unit. The 33 unit. For it to make sense, because once the cap rate, which is about 4.7 at the listed price. I think 4.5 at the listed price. The only way this is going to make sense is if I buy this at less than 100 a unit, because the cap rate is not there, right? It's maxed out.
Yeah.
The rent is not there. It's maxed out as well. That regardless of the renovation I do, I can't really charge more than what it is. Does that make sense? Regardless of whatever I put in there, because that's the market. Is yeah, we have a renovation premium, maybe about 5%, 10%. It's not like the US where you can do something crazy, right? So there's no real upside there. The only way I could get upside is to reduce the price, and that's the only way it's gonna make sense. That's the only reason why I'm still considering, I'm still looking at it. If I get significant price reduction, at least it has to be less than 10,000 compared to the listed price.
Yeah, no, I definitely. So because the reason I asked you that question was, so like maybe they're pricing it in terms of what the market was, like 6 months to a year ago, and that's what they're quoting you, whereas the market and even like comparative rent right now is going down. So like the if you look at the owner equivalence rent and even the average house price, it has gone down like recently.
Yeah.
So maybe I think it's just a valuation kind of a thing, because there's not much room in a real estate deal to charge a premium, as you said, right? Like you can't really do a lot in that. So that's what like I don't really understand, like why, like either the price is high or there's definitely some unnormalized things happening in that business for sure.
Yeah. Because it's debt coverage ratio is 1.54. That's that is very high. So in terms of that's a bit difficult one. Okay, thank you guys. I just wanted to hear your thoughts on that.
Yeah, no worries. Hey, that's why we put all this stuff together. Use it as much as you need. Matter, you got some things I couldn't get, so I appreciate that, and hopefully it takes you in the right direction. So then, what specific outcome are you going to run with now?
Depends. We can reduce, but I can get the price reduced significantly. Okay, I might consider it, but in this case now, we have to more or less try to get investors that are not looking for capital, but they're looking for capital appreciation.
Yeah.
So the struggle, I'm trying to get capital to pay my investors, but whatever capital, either we you're invested in the properties. So what we're targeting in exits. Since exit is just 3 years, right? So we're targeting maybe a 16% IRR or 1.5%, 1.5 x instead of a usual 5 year holding, then targeting a 15% IRR and at least 1.7 to 1.2x. So because it's a shorter period of time, that's what I'll be looking at anyways. That's what I'm thinking.
Yeah.
If I could get the price reduced significantly.
Exactly, and it can also help to also talk to. We have what Octavio and those folks. They're working on some serious transactions. They're investors themselves. Octavio's partner, Danny's partner, he had $1 million to invest when he was 25, and he's been investing in real estate for a while. So it may be productive to. We'll get somebody to get you connected. Just so maybe you can share an opinion. They're looking for hotels.
Okay.
Yeah, they're looking for hotel investors. In the future, you can just say, "Hey, in the future, I'll help you with hotel investors. Like, let's just meet. Like, what do you think it is?" And then he's a direct investor anyway, so then you can get a good opinion. So I'll get you linked up with him. Also, what else? What's the second thing? Also, I mean, this whole recession story too. I mean, maybe you can play up that angle too, because Matter, did we not say that? Hey, real estate's it's going down like this, and then 3 years after, maybe after the recession, it goes up. I don't know what investors are going to say, but maybe you can use that as part of the narrative, eh? If it's capital appreciation, the prices are low,
Yeah.
we're at the bottom, and you get high after the recession.
Yeah, sure.
Cool.
Yeah, which is one of the reasons why this is more than for just 3 years, since the holding and says the remaining number of years on the debts. The debt time, just 3 years left. It ends 2023, 2024, 2025. So by June 2025, that's the end of the term of the debt.
Yeah.
That's why I'm modeling for just 3 years. Let's just hold it for 3 years. Hopefully in 3 years, maybe if the market have improved, maybe we'll go back to a 3% interest rate at that point. Yeah, might be worth it at that point to refinance, take some money out, and continue to hold on to the property.
Yeah, and again, that can always be the running story or the hypothesis, and then we'll see if everyone believes that. If they believe it, it would just feed into what the investors believe. Whatever they believe, we're going to just sell them whatever they believe, so you can just get this thing closed. Obviously ethically, but just so that they don't give you any slowdown, So.
Absolutely.
All right, cool.
Okay, thank you so much, guys.
No worries.
Thank you.
Yeah, good call. Thank you, Matter. I learned quite a few things here, really insightful. So then, we'll get the introduction and let us know if you need any help. All right.
Yeah, sounds good. Thank you, Doctor.
Yeah, cheers, guys.
Thank you, guys. Cheers, guys.